You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. And today is, of course, Wednesday, and it is the day when we have Zulfi Ali from Valerity Group with us. Zulfi, how are you?
I'm doing great, Buck. How are you doing?
I'm doing okay. Lots of craziness out there.
Oh, yeah.
But yeah. Well, you know what I'm talking about, and a lot of investors do. But let's see. Let's talk first about, let's talk a little bit about that show for the week.
Yeah, you covered due diligence.
Yeah, right.
Which, very timely discussion. I think it also highlighted, the challenges we all face when we're trying to get comfortable with an investment. And it's particularly challenging when we don't know the counterparty, when you're dealing with someone new or unknown. But it can be equally challenging when we think we know the counterparty and we've come to trust the counterparty, right? So a lot of times in that kind of situation, your guard can be down a bit. And so you have to be, just as diligent to do your due diligence in either scenario. It's an absolutely critical exercise to undertake. I think what you have to understand, and I think what you guys, discussed is correct, which is you can do all the due diligence in the world. It still might not protect you from a bad actor, right? Especially when you've got, a situation where someone is particularly clever, or maybe, as you brought up, the person you're dealing with may initially have started out as a bad actor, but due to some circumstance becomes one over time. That can be a real challenging situation. I think
I brought up, of course, the most famous case in that world, which is that of Bernie Madoff. And
sure,
I think, you and I have talked about it before. You know a lot more about it, but maybe you can kind of help us understand. Well, first of all, it's how big it was. Like, I think a $65 billion, essentially a Ponzi scheme, right? And so remembering Bernie Madoff was like kind of a big deal on Wall Street, right? Why don't you start off with that?
Yeah, I mean, he started his career in the 1970s. He was a penny stock trader, and he specialized in trading, smaller, illiquid securities that are not on the New York Stock Exchange and that sort of stuff. Over time, his firm developed a technology that was eventually used to power NASDAQ. I mean, it was that good. It was that cutting edge. His firm was one of the top, firms trading shares on NASDAQ. And so, there was a lot of credibility there for a guy that, again, started back in the 1970s and really, really developed the market on non-listed securities, but public securities. And, over time, what investors really came to love about him through his funds was that he generated an extremely consistent return over many, many, many years. There was very low volatility in the returns. It was nothing fantastic in the sense that he wasn't like beating the S&P by X% every year. What he was effectively doing is performing relatively in line with the S&P, but in a less volatile manner. Right. And so people like that. Institutional investors like that. It's like, okay, we're getting, nice equity returns. We don't have to worry about the volatility in the public markets. Bernie's got this thing. So that's, something that he did.
So did he ever disclose? Did he ever disclose what the investments were in and stuff? And wouldn't you be required to show that?
Yeah, he did. I mean, he had all sorts of disclosures, and the thing about deploying a strategy such as his, it's relatively complex to unwind that, right? So it's not just investing in the stocks themselves, and that's what he was doing. He was, for the main funds, he was investing in the big stock market, but with all sorts of different hedging, collars, puts, calls, all that kind of stuff to try to, create a less volatile return.
And typically that would be proprietary, right? Because that's
absolutely
sort of okay, that's what makes us different. So we don't really have to tell you exactly what we're doing.
Yeah, they can tell you the broad strokes, but they don't necessarily, just like, hedge funds today, that's their secret sauce. They're not going to tell you how they're generating those returns. They can tell you what asset classes they're investing in, but how they're investing and when they invest, and then all the structuring around it. You're not going to get the details of that, and neither did he disclose that. Although, people would question the amazing consistency, right? No one is supposed to be that consistent in the markets. It just makes them an outlier. And there were people that as early as the 1990s started questioning whether he was doing something other than up and up investing. There was several SEC investigations. So in 1992, 1999, 2000, and they all came away, each time no major concerns. So the SEC would go in there. Bernie and his team would present all their records and this and that, and in such a way that obviously they got it by the SEC in those investigations. And so what really actually triggered his arrest was that his sons ended up reporting him. So they were also working in the family business. They were on the trading side. Bernie was running the funds. At some point when it looked like, there was a bunch of redemptions going on, apparently he called his sons in to kind of just say, hey, your dad's been running a Ponzi scheme and blah, blah, blah. And
so they didn't know about it?
They didn't know about it. They were in a legitimate business, actually, that was also under the Madoff, empire, financial empire. But they were on the trading side, and he was running the fund. So, yeah, when they found out, they basically called the authorities.
Well, he probably told him to. I mean, he probably was like, save yourself because,
It could be, yeah. I think the way the story, as I recall it, is he had devised some plan where he was going to take out a bunch of money and make a run for it, and they basically wanted to stop that, and basically got him shut down. So
yeah.
Anyway, but you see how that demonstrates the challenges, right, of discovering
because
fraud.
the other thing that I don't know if you mentioned this, but there were audited financials. Like people talk about how audited financials are bulletproof, and if you have them, they actually, vindicate. But in this situation, there were audited financials. So how did he get those?
Listen, you can also sneak stuff by the auditors, right? There's, if you've got enough complexity that you can, hide behind, eventually you can position in ways that it gets behind even the auditors, right? And what's another good example, and this time of public companies, if you recall, the likes of Enron and WorldCom, right? These were very large public companies at the time that they went bust. Some of the they were the largest public companies ever to have gone like this. And it was the same thing. It was discovered that their financials were baked with a lot of fiction. And of course they're audited financials. But how did they manage to get that through the auditors? WorldCom in particular, as I know, was always doing a lot of M&A. And when you've got M&A, there's a lot of messiness that happens. And so they would be able to just kind of hide some of the real results and that sort of thing in kind of the complexity of an M&A transaction.
Of a mergers and acquisition.
Mergers and acquisitions. And so, again, at some point, everything caught up to them and they went under, including the audit firm at the time, right? One of the big five at the time, but they're no longer around as well.
So that, and again, that becomes really interesting because some people would be like, well, gosh, maybe it's just the private stuff and maybe you stay away from the private, but it happened in the public companies too. So, it reminds me, do you remember, this is like one of my favorite movies of all time, but In the Line of Fire, do you remember that movie? It was John Malkovich and Clint Eastwood, and it was like John Malkovich was trying to assassinate the president. And
I vaguely remember that.
Yeah, it's a really good movie. Anybody should check that out. But Clint Eastwood was this retired Secret Service agent who had failed on Kennedy. So Malkovich was playing him. It was part of his game, and he was ultimately going to kill the president. And one line sticks out to me in what John Malkovich said. He said, anybody can kill the president. He said, all you have to be willing to do is give your life for the president's. And so it makes me think of that because in some regards, all you need to do is be willing to go to jail. do something that you're willing to go to jail. And really, at that point, you can figure it out. You can figure out how to fool people and
Yeah.
you know?
I think, my instinct is that it happens incrementally. Like, it's not necessarily the case that these guys start out saying, I'm going to do big old fraud. They start doing some business and maybe it works for a bit, and then all of a sudden circumstances change. They need to do something that is, less than appropriate to cover up something. They do it once thinking, okay, I'm going to get back on track after this. And then they have to do a bigger one to cover up the next one, and so on and so forth. So, but yeah, I think there's a certain point where they're just like, okay, I know now that if any of this comes out, I'm going to jail. So all I've got to do is keep the fraud up, the fraud up, and, keep everything going. So anyway,
I guess the question is, okay, so the good thing about, a lot of what we do is real estate. And the nice thing about real estate is it's kind of hard to like fake real estate. You drive by it, you can see public records, you can see, how much something is, it's really hard to fake that. However, that's not to say that real estate was without risk, as many of us found out over the last few years, but at least if you're losing money and it was an honest reason for losing money, like the markets or whatever, it's one thing. I guess the question is like, how do you do? I mean, obviously, I know we'll talk about what you do as due diligence, because that's one of the reasons I think it's good to work through a broker dealer. But tell us how do we protect ourselves?
Yeah, I mean, listen, it's again, there's no guarantees in life, but the reason you do due diligence is to just make sure that if there's anything that is obvious, there's anything that you should be able to catch, you can catch it, right? And so, the way that we do it as a broker dealer, in terms of the scope, it's like looking, okay, who's the operator, who are the key principals involved, and by that I mean, making sure that their skills, their background, their resumes are really reflective of who they say they are. You gave an example of a guy that, was supposedly, very, very, I guess, experienced or connected into a certain field, and lo and behold, he wasn't coming up on a basic internet check. So that's a very good place to start is just, Googling their name and that sort of thing. What we do is definitely more invasive. So we do run background checks on the operators. So the key individuals that are involved in any of these deals, we'll get them to provide, their IDs, their social security numbers. With those bits of data, we can run very detailed criminal records checks, prior bankruptcies checks. We can see if there have ever been any violation with federal regulators. We can see if they appear on any sanctions list, for money laundering or whatnot. So there's a lot of information that we can do on individuals to at least check if they've been involved in anything unsavory in the past, right? So that's not to say that someone that's got a clean record won't do something in the future, but at least it's one filter that you can say, okay, I'm not working with someone that is a known criminal, a felon, someone who has violated securities laws, all that kind of stuff. So you can at least tick that. You want to make sure that, the entities that they've set up are properly incorporated, they're in good standing, they have the proper governance, all of that sort of stuff. And so, we'll do extensive review of, the entity documents. We'll check those as well against sanctions list. We'll make sure that they're in good standing. All that kind of stuff has to happen. Then there's the process, obviously, of checking to see what kind of track record of performance these individuals or the company has had, including their, historical financial statements. As you mentioned, ideally we'd like to have financial statements because it's an extra layer of a third party specialist that has taken a look at it. Again, not foolproof, but helps a lot if that's the case. But with a private company, it's not always the case. Financial audits are expensive. You could have a business that's a new fund or a new property acquisition that's coming up. There's nothing to audit because it's just coming together now, and you're investing in the acquisition of that asset, right? So not always relevant and not always available. So that's a little bit of a challenge. But you should be able to go through some track record of the operator and really get a sense of what they've done in the past, right? And so on. I mean, you look at the business plan, make sure that the assumptions that are baked into the business plan that are supposed to generate the returns for the investors, they all make sense. They're in line with market expectations. You can, definitely flesh out times when, the operators might be a bit too aggressive or, maybe, underestimating certain things. So that sort of stuff. And then there's a big review of all the disclosure documents. So the PPM, operating agreements, subscription agreements. We make sure that all of those have appropriate disclosure. They're written very clearly and transparent. I know nobody reads this. Very few people. Actually, of the investors that we've had, there's a handful of guys that I know that do actually read them, and they come up with, questions and ask those questions. But most people don't have the time, right? And so they're relying on someone else to have gone through and make sure that that all that disclosure is there, all the risk factors are discussed in really good detail and give a good sense of the risks of the deal. And again, that's something that we have to do before we share any of those documents with investors as a broker dealer. And then there's fund level due diligence. If there's a fund, you're seeing who's in control, what rights do investors have. There's asset level due diligence. This is where you brought up on the single property. It's a lot easier when you've got a single property to due diligence, right? When we're doing some of these multifamily real estate properties, I get a ton of information on the property because basically I'm asking the operator to give me everything that they've done on the property themselves. And so I get third-party diligence reports that I review. I get, any kind of information historically, financially, operationally on the asset. So that's very kind of concrete work that you can do. It's more challenging when you're diligencing a fund because sometimes there's no assets. Yeah. Those are on the come, or there might be assets that are already in there, and then you have to go back historically, see how those are performing relative to expectations and all that sort of stuff. But still doable. And like we said, it's most challenging when you're looking at businesses. Complex businesses, particularly ones that do a lot of mergers and acquisitions. It just leaves a lot of room for distortion. And so you have to be extra careful in those kind of situations. But anyway, it typically takes us several months to conduct full due diligence on any given opportunity. So it's a real tedious process, and it needs to be undertaken.
Let's shift into what's going on with the markets this week. Why don't you go talk about that?
Yeah. Well, I mean, since the last time we spoke, there hasn't been a lot of new economic data released, so nothing incremental has changed. Chairman Powell was out earlier this week, Monday, in fact, at some economic conference. He, reiterated U.S. economy is solid. And the Fed is committed to doing whatever it takes to engineer a soft landing. He did lower expectations going forward. He kind of told investors not to be expecting another 50 basis points cut in the near term. And instead, based on the data he has today, he's thinking that, 225 basis points cuts for the rest of 2024 is probably the appropriate direction. But again, he's completely data dependent, and the Fed will navigate accordingly as the stuff comes out. So nothing really meaningful there. We had a job openings and turnover survey that released actually Tuesday, and that nothing much there, showed that jobs remain stable. The next meaningful economic data will come out on Friday of this week, which will give us the September unemployment data. Market is generally expecting a volatile report there, and unemployment should stay at 4.2%, which is what it was for the month of August. Any surprises up or down, I think markets will react. So that's kind of U.S. market. I thought there was some pretty interesting stuff coming out of China. I know most of us aren't interested in investing there, but
they affect the
interesting.
rest of the world. So, I mean,
They do.
yeah.
They do. They are the world's producer, so manufacturer, that is. And so, yeah, the government announced, that there's, so they announced several kind of stimulus packages to help, charge the economy back into growth. It's been a really, really tough economic backdrop in China for, for the last few years. Basically, they lowered mortgage rates even on existing home loans, which is something that you can do in a country like China, I guess. And
Yeah.
wouldn't that be nice if the Fed could come out and reduce your existing debt costs?
Yeah.
And they also made it easier. They provided this facility where investors can borrow to invest in stocks. So, I mean, that's very aggressive, right? I mean, it actually, encouraging folks to take out debt to invest in stocks.
Sounds kind of dangerous, doesn't it?
It sounds really dangerous, but I think they're really, really trying to, get this thing to stop their economy, to stop the decline. Stock markets there rallied huge. I don't know if folks watch the markets there, but 20% in the last 5 days. It's the best performance in that market since the mid 1990s. So
can people even? I assume you can if you want.
You can buy ETFs. You can buy ETFs that give you exposure. There are also certain sectors that trade in the U.S. market. Like you can buy EV stocks, right? BYD, Lee Automotive, NEO. I mean, these are all kind of trading in the U.S. as well, and all of those have run up quite a bit over the last week or so. So you can get exposure, but I think it's tough. And my sense is that this signals a lot of desperation.
Yeah,
from
it's
the Chinese
weakness
side.
for that economy. I mean, like it seems to me that they're headed towards something bad.
A little bit of a desperation, for sure. And they've got this huge issue with housing vacancies. Just the vacancies like ridiculous right now. And
well, on top of that, they've had decades of one-child policies, and so you're not feeling those things anytime soon.
It's a debt spiral. It's a debt spiral. Right
zero
now.
immigration, right?
Yeah.
So
if anything, it's people leaving when they can. So anyway. Back to the U.S. I mean, we've been just the opposite here. Just phenomenal, economy. At least financial markets love it. With the end of the third quarter on Monday this week, the S&P returned 21.5% year to date, which is a pretty spectacular return. It's the best performance since 1997. All of the stock indices, the Dow, the Nasdaq, they're all either, at their highs or trading very near their highs as of the beginning of this week. Although, today in particular, there's been some volatility, today being Tuesday, as we're recording this, just because the Middle East seems to be percolating again with tensions. Oil prices have spiked up by 3%. Gold is up almost 1% on the day. I think it's signaling, people trying to get some safe haven investing going there. So that's something to keep an eye out for. I think, if the Middle East continues to spin out of control, that does have impact for global economies.
Yeah, there was
and that sort of thing.
And we're recording this Tuesday, but when I was working out, I saw something about Iranian missiles towards
missiles. Yeah, I saw the same headline. Not a lot of detail, but
Israel. Yeah, lots of them, like hundreds of them.
Yeah, and that is, I mean, if that is the case, that's serious escalation, right? Up till now, Iran had been using its proxies, and here you've got them directly launching missiles. I mean, that's going to get answered, and so. Tough situation. I think oil is, the key commodity that gets impacted and then has a knock-on effect for what could happen over here as well.
And that certainly could throw a wrench in the soft landing. And who knows, maybe the accelerates the Fed's activity in terms of lowering rates, but who knows, right?
It could. It also spikes up costs
Yeah.
because oil prices go through everything. So so I think something to keep an eye out on.
Hey,
and then
I mean, do you know, like, how do oil costs? I mean, because I always thought, I always hear about how, the U.S. is essentially, we produce enough oil for ourselves. So, like, why are we so dependent on what happens in the Middle East anymore?
Well, it's a global. There are global kind of prices, right, for all these commodities. So if we are essentially self-sufficient, from oil perspective. But what happens is if the prices go down, it becomes more challenging for the domestic production. We have a high cost of production in the U.S. because a lot of it's shale, and so they have to stop. They have to turn off the spigots in the U.S. when oil prices go down, because it's actually cheaper to just import the oil from lower cost producing countries. And then it's kind of the opposite when oil prices start spiking up. U.S. producers can start turning on the spigots. Now, it does take some additional capex to get oil, pumping oil again. And so, U.S. companies typically will wait until they see that it's going to be a sustainable price increase, and so they might let the prices go up. And only when they are feeling good that they're going to stay up, they'll invest the capex. So there's a delayed kind of reaction to that, but some of it's related to a cost of production issue as well.
Interesting. Well, okay. What else? We want to talk about? We got that. Bitcoin is, well, I don't even know what to say about Bitcoin. It's kind of down, but it was up and down, but it's not doing anything terribly dramatic.
It's not doing anything dramatic. Bond yields are relatively stable from last week as well, so nothing dramatic there. I think just personally, I'm not offering advice to anybody in their specific portfolios because they got to do it based on their own situation. But I do worry a bit on the public equities levels. I think they are
frothy.
Priced for perfection.
Yeah.
They're priced for perfection. If everything works out beautifully, you can justify the valuation. If we don't get the outcomes on a soft landing and a nice resumed economic trajectory, growth trajectory, and all that kind of stuff, or all of a sudden escalation in the Middle East becomes really bad, there's lots of room for volatility and downside. So that's something that I'm keeping an eye on, certainly with my own portfolio, and so folks should do the same. I'd rather be focusing on cash flowing real assets
that are distressed, right?
With a story. I would say that is a great story, right? So that's what I mean by that, which is there's some specific dynamics around an investment that make it compelling. And so it could be buying assets from a distressed seller. It could be that you have real estate in a particular geographic region that's just positioned for growth. It could be investments in assets that are increasing in value because there's some scarcity or disruptions to a certain industry. So I I'm looking at those types of opportunities when I'm evaluating investments for myself.
Yeah, I mean, it reminds me, I don't remember who it was who said this. Was some famous investor, but he said there's always something on sale, right? Yeah. And when you look at these S&P 500 numbers or the market numbers 21% up. The problem is that like people hear that and psychologically they say, I want a piece of that too. But see, the problem is that that's all in the rearview mirror now, right? And you can't, and that's like jumping into froth, and that's sort of human nature. I'm not saying it's not going to continue going up, but what we do know is that there are, like we talked about before, and we've talked about several times, there is this fairly distressed real estate market right now, and it is on sale. Like if it is on sale, the stuff that's out there, it won't be for long, because I think as rates continue to go down, I do think that a lot of that distress will go away. But that's what's on sale right now. So.
And the reason I like that particular strategy as well is you can focus in on a very microeconomic region, right? And so you don't have to worry about, oh my gosh, what's going on with this in this part of the world or that. It's like you can look at the dynamics of that very specific catchment of where that asset, real estate asset, is located, and you can decide, okay, this should be well buffered. This has some growth, trajectory, and therefore you can be comfortable with it. So that's another nice element to that type of strategy.
Well, I know we don't really necessarily have a product to talk about or financial, a thing to explain necessarily today, but I'm curious about your. And you're probably not even following this, but the Minnesota Vikings are now 4-0. Their offense right now is number one offense in the NFL, with former number 3 overall pick Sam Darnold, who's being paid $10 million, which is really nothing for a quarterback.
Yeah.
Who's got the highest quarterback rating in the NFL right now. They've beat the crap out of 2 NFL contenders, San Francisco and Houston, two Super Bowl contenders, I should say, and then Green Bay. They were beating them 28-0. Of course, they almost lost that one at the end. But are you following this at all?
I'm not, and you don't want me to, because the second I start voting and get myself excited, that'll be the end. So just for your sake, I'm going to specifically not pay attention to what the Vikings are doing.
Okay,
it's for you, Buck.
Thank you. I appreciate that. Okay, well, we'll leave it at that before we jinx anything else.
Exactly.
Okay, well, it's good having you, as always, and we'll catch up again next week.
Sounds great.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.